In this week's update, who fired the starter's gun on Friday? A US market that just wants to go up, and the opportunity set for multiple years to come. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with the usual market perspective, and the message that really came through loud and clear to finish the week in Australia, and I guess has always been an underlying theme in what I've been presenting, is that there's always something great happening. You've just got to know whereabouts to look, and probably more importantly is how to look, how to think about the opportunities in the market, and don't be guided by the media or by consensus thinking. So I'm as enthused as ever. We're in September. This is just about the weakest period of the year. Yet there's nothing terribly dramatic happening. It's just also positive in certain pockets. As always, my advice has been to focus on the highest quality companies that are in megatrends, that have got the tailwinds that being in that environment provides. There's also terrific opportunities in miners that have got some sort of X factor, be it their resource, their management, their strategic value, whatever it might be. There are also other tremendous stocks, niche stocks outside of mining as well, that come into play from time to time because of their contrarian setup. And I talked a lot about the importance of having a bit of a contrarian mindset last week. So what does one need? Well, you need a simple overview plan of what you want your portfolio to look like. And I'm just, I guess, surprised that so few people that I talk to, new members coming into our services, that want to start with just stock picking. You know, I like this stock and this stock, and don't actually start with, well, what do I want the composition of my portfolio to look like? And then break it up into sections and work from there. And it's such an easier process to do. So my advice would be to get that simple overview, break it into defined categories according to the parameters that are important for you. And I regularly give people assistance in how to think about that. And it really is a pretty straightforward process, but it just doesn't come naturally to most people. And then once you've got the categories identified and the very rough weightings, you start to identify the targets within each category, and then identify some rough entry zones. And that really, makes the whole process very much unemotional and data driven. It's not based on the emotions of what you think you might like or what the media might be talking about at the moment. And then, of course, the most important ingredient, and perhaps the most difficult thing to do, is then to wait for the opportunities that come and execute with confidence. And it's not that easy, because we've got this constant battle with what's going on in our head, but it's certainly the way to go about getting consistent success in the market. So let's have a look at what is the US market up against. So the US market sets the sentiment tone for the rest of the world. So even though you may not trade or invest there, it certainly has an impact on what we do. And I could come up with a very long list here, but here's just a few. We've got yields rising again. We've got oil prices now beyond $90 and all of the negative implications that has for inflation and the economy. We've got lawsuits against big tech, not only in America, but also in Europe. We've got a coordinated strike action against the auto industry in America, and who knows where that's going to lead, et cetera, et cetera. I could go on for some time and come up with a huge list of negatives as to why the S&P 500 should not be rising. But you know what? It just is. And it just seems to want to go up. And we'll have a look at that chart in just a minute. And in fact, the S&P is up 15% since January of this year. So that's pretty amazing when you consider the backdrop. So it all goes to prove that logic, the news, the predictions, they all count for naught. And again, I covered some of this last week, and it's pretty graphic when you look at some of the high profile predictions that are out there that would just scare the pants off you, the market falling 80%, et cetera. And, they just generally don't come to anything. So let's have a look at the American stocks to start with. The S&P was down 0.2% across the week, but it was options expiry week. Friday was negative, and often, in fact, nearly always, the price actions can be extremely short-term, counter to the prevailing trends. And really, I think if you place much weight on what happened in the few days before options expiry or the few days following options expiry, then you're probably getting a very misleading picture. So probably best just to, just ignore that little period of price action. There are plenty of transient events that continue to create just some wonderful medium-term and long-term opportunities. And we see those every week. There were plenty more. Friday, there was some concerns in the semiconductor market because of some data out of Taiwan Semiconductors. But, who knows what the headline will be next week and how the market will respond to that. US dollar index continues its breakout up a little bit further, 105.3. The 10-year yield is up to 4.33. The VIX, 13.8. So it's sort of staying pretty stable. Sure, the market was down, but there wasn't really that much fear in the market. And the 10-year, 2-year spread is still singing the same song, roughly 0.7 negative, indicating a recession is still coming. But the bond market's been saying that for quite some time now. All right, let's first of all, let's just have a look at the bond yields. So this is the 10-year. We'll take a look over the last 6 months. So you can see it's been a few ups and downs, but there's no question the trend is still to the upside. And yet the market is, the market sold off in 2022 because of fears that the yield would do this. Now that the yield is doing this, the market is going up. So the equities market is looking over the fence. It's looking beyond what is happening in the bond market at the moment and expecting things to be quite different. So one of those two markets has got it wrong, and I'm not going to hazard a guess which one that is. Just at the moment, there are terrific opportunities in the US, there are terrific opportunities in Australia, and I'm just working those according to a plan and not worrying too much about the other. I'll come back to the oil price chart shortly, but let's start first of all with the S&P. So this dotted line here is calendar year 2023, and this is the story. It's been a bit volatile. We certainly were volatile in February and early March, significant dip. And then we recovered. We've had another dip just recently. But through all that, the S&P is maintaining a trend that has propelled it so far, and we're only 9 months through. We're not even 9 months through yet, and the market is up 15%. So it's possible with a year-end surge that the S&P could top 20%. And there was hardly anyone at the start of the year was talking about the S&P being up more than 20%. So you've just really got to observe and respond rather than try to anticipate is the bottom line. All right, let's look at before I do that, I'll just look at IWM. So let's have a look at the Russell. Not so much of a trend here. Looked great for a while. Peaked out here in July with a double top, and since has really been struggling a bit. So the breadth of the US market is not all that flash, I would have to say, but nevertheless, the S&P is doing what it's doing. Okay, let's take a look now at the individual parts of the market to give us an idea of where the money flows are going, if anything has changed there. This is the NASDAQ versus the S&P, no change. So nothing different there. They're still roughly in balance. In the last week, semiconductors has come off a little bit relative to the S&P, so they've been a bit weaker. But nevertheless, we're still just consolidating tremendous gains that we'd had. We've been consolidating now for around 3 or 4 months. but the low of that ratio occurred in October last year, and it's been strongly to the upside. Semiconductors, a little bit out of favour at the moment, so maybe there could be a contrarian opportunity there if it dips sufficiently. And let's take a look now at the individual sectors. We'll start first of all with the last. In fact, let's look at the last year. So up the top, we've got our aggressive sectors: technology, communication services. Then we've got energy. Discretionary is sort of down here in the middle of the pack, but because of the dominance of Tesla and Amazon, I kind of largely ignore that one now. So that is what this year has looked like. And at the bottom, we've got consumer staples, which is obviously defensive. We've got healthcare, which is defensive. So that's the story of the year in the S&P. Let's zero into the last quarter. And you can see XLE has been a massive success over the last quarter. XLC, we've got some improvement in finances, and then we've got XLK has sort of really dropped quite a lot in the last week or two. And so if we zero in on that time frame, you can see XLK right at the bottom. So despite the fact that a lot of people always talk about big tech and how it dominates the S&P, and that's the only reason the S&P is going up. Well, the S&P was only down 0.2% over the week, and it's been reasonably stable over the last few weeks. And yet, look at what XLK has done over that period. It's just dropped through the floor on a relative basis. So, pretty interesting to look at that sort of chart, because it gives you often quite a very different picture to what the media is painting. I just want to zero in on a couple of other charts. So let's just look at technology as the index, not as a comparative chart to other charts. So that's XLK. So you can see, really, it's not much more than a consolidation, really. It looked a bit ugly on a relative sector basis, but there's nothing terribly scary about that chart. 200-day moving average is still heading up very nicely. We're getting a little bit of sideways action now from the shorter term moving averages. This just looks like a bit of a consolidation at this point in time. This is XLE. We're back now to the highs that we were at in November of last year. So certainly it's had a good couple of months in energy. And of course, uranium. If you haven't picked up on the fact that uranium is doing incredibly well of late, then this chart, weekly chart of URA, which is uranium producers, pretty much tells the story. And you can see, great breakout, great candle, terrific volume. There's lots of good things happening in uranium. But look, that story was, the opportunity time to get into that was earlier in the year. It's had a very significant run. So, don't be too anxious to just go and jump into some uranium stocks, because we've had such a powerful run in the last few weeks. We could just get a bit of a short-term pullback. So there could be another opportunity building there. And just to touch on currencies, while we're here, there's the US dollar index. Bottomed out in the middle of July, and it's been pretty much straight up since then. And the Australian dollar has, of course, pretty much gone the opposite direction. Okay, Aussie stocks, our $63.7. Our market gained 1.7% across the week. It was a very strong finish on Friday. But if you pan back and take a bigger picture look, as we'll see, our index is an index going nowhere and hasn't done anything for more than 3 years. But the overwhelming message is that we've now got evidence of a rotation out of defensives and into growth stocks again. We're through our earnings season, and I think it's really instructive that the money flows in Australia have changed around quite significantly. the reaction to earnings season is always about not the result, it's about the result relative to expectations. So, I still get questions from people saying, why the company came out with a good result. Why did the price go down? Well, the price went down because the good result just didn't meet expectations. So the result itself is not the driver of the price. It's what were the expectations and what is the forward outlook. Pricing power is king. You'll find that nearly all of the stocks that are doing really well, that are trending strongly at the moment, are generally stocks that have got pricing power, and they were the ones that got a good reception during earnings season. Quality small caps have been a contrarian trade, and I'm talking about real quality stocks that deserve to be significantly higher in their PE multiple than they currently are. That's been a contrarian trade for some time, and it's taking a while to click into gear because there's still quite a lot of quality small caps that are still trading on PE ratios that are much lower than they should be. And eventually that corrects itself. So it is coming, but as with uranium, we had to wait several years for the logic of and the true situation around supply and demand in the uranium market to actually kick in. So my advice would be, if that's an area of the market that you want to be in, that you get some targets lined up, get some rough entry areas lined up, have a bit of patience, and I think over the next couple of years you might get a very good result in small caps. The finish in Australia on Friday was quite startling. Again, not so much at the index level. I think we're up around 1.3% on Friday, which is that's a pretty decent day. But a lot of the stocks that are in our portfolios did far better than that, and outside of the portfolios as well. So a lot of tremendous individual great performers on Friday. Let's take a look at the Aussie indices, so the ASX 200. So you can see really strong day Friday. If we pan right back, you can see we're just at the same level as we were at in 2021. And if we go back a bit further, we're at the same level as the peak in February of 2020 before COVID hit. So really an index that's going absolutely nowhere, but within that, some tremendous opportunities. Energy, not as strong here. It's nowhere near as strong here as it has been in the States. And I think part of that is perhaps the regulatory environment that's now beset the energy market in Australia. Makes it very difficult to fill. Sorry, that's finance at the wrong chart. But look, while I'm on it, finance not really doing anything either. So finance has not moved since February of 2020, so 3.5 years. There's the energy sector. Apologies for that. But the energy sector is still hasn't quite returned to the highs of 2018 and 2020, and has really been consolidating since all year. So the Australian energy market is not as strong as in the US. Healthcare, still in the doldrums. There's been some real compression of PE multiples in the healthcare sector. There's the ASX 200, and finally materials. Materials was the strongest sector on Friday, and there was some data out of China that certainly helped that sentiment. All right, precious metals, gold up $5 to 1924. But we've been stuck in this range now for about 3 years. That's why I've been saying for a long time that I've really moved away from gold producers. I've moved exclusively to advanced gold developers, the real world-class stocks, where it's almost a given that you're going to get a share price increase in the future based on the de-risking of the process or the project. So not much happening there in gold. We're slightly lower in Aussie dollars at 30.20, and producers are pretty much saying the same thing in the gold market. So we'll just have a quick peek at that. So there's gold on a weekly basis. So you've got to go back here to July 2020 and we're still trading at the same level. It's just been going up and down sideways. And that's the daily. If you remember that chart and then look at GDXJ, looks exactly the same. So there's really not a lot happening in the producer side of the gold market. But as I said, it's the developers that have got some sort of X factor, some sort of world-class resource, proven management that gets the job done, whatever it might be. That's where the value uplift is going to come in the next couple of years. Showed that one last week. Turning to other commodities, copper is at $3.80, up a little bit. Nickel also up just a tad to $9.02. But crude oil was the big story of the week, up to 91.2. So why is that? What's driving the crude price? Well, the demand is not dropping off as expected, and I've been saying that for 2 or 3 years now, that the demand would not drop away, and the same thing's happened in coal. Consensus thinking was that the demand for coal would just fall off a cliff, but it hasn't. Saudi and Arabia Saudi and the Russians have cut production, and that combined with the fact that demand has not dropped is creating this imbalance. It's becoming more and more obvious that the economics around renewables don't work yet, and Germany has had to put in place an incredible turnaround. They've shut down the nuclear industry, but they've now had to start up coal, and I believe buying power from France, because the economics of renewables just don't work and the practicalities of renewables don't work yet. It's not to say that they won't, but the world has tried to engineer this transition just too quickly. We've also got the US strategic reserves are still low, so there's a requirement for more buying there. But with the oil price up at plus 90, then who knows? Joe Biden might decide to release some more from the strategic reserve that's still too low. Who knows? Capable of anything over there. Of course, the high oil price feeds into inflation, but then on the other hand, it takes money out of retail pockets because everything gets more expensive. So how does that balance work out? I think that's for minds smarter than mine to think about. But the interesting question is, where does that leave the Fed? The Fed has to make a decision about whether they raise interest rates again or not. It's quite a dilemma for the Fed. There's a lot of very conflicting directions. We've got inflation going down. We've got oil prices going up. Gazing into the future and trying to work out what it's going to look like in 6 to 12 months' time is no easy feat. That's for sure. Okay, let's take a look at the crude oil chart just to give you a sense of what crude oil has done. So we'll look over the last 6 months. And you can see pretty much straight up since late July, and we're now exceeding the peaks. And if we look at the year to date, then it's the same picture. So we're at the highest prices for crude oil that we've seen all year. There's a spot copper chart. Not much happening. Same with nickel. So we're not getting the response yet in the base metals. Wrapping it up, the best opportunities arise when few people are looking there, by definition. If you want to buy into a crowded trade, if you want to buy into a popular trade, then just think about it. It's popular because most people are in it. So who's left to buy? And what happens if a few people decide to sell? Flip it over the other way and think, well, if we've got a quality company and the price is down for whatever reason, short-term reasons, misperception, whatever it might be, then there's, if no one is really looking there, then the selling has probably been done. It just takes an opportunity for something to turn that around in terms of sentiment, and you've got a new uptrend potentially on your plate. So the important thing is to break out of the comfort cycle, the consensus cycle of thinking, which is very easy to slip into. It's more comfortable just to do what everybody else is doing, but it's not where the money is made. If that's all you do, if you just go with consensus, go with the media, then you're never going to get as good a return as if you try and look at it from the opposite side. You want to look where others are not looking in the short term. So that all starts, how do you do that? How do you go against the crowd? Well, it all starts with some clear planning and perspective on where the bigger picture is going. What are the mega trends? Where are the earnings certainties, if you like? And take it from there, as I outlined earlier. And we do a lot of that in both services, both Portfolio Analyst and the Insiders Club. Portfolio Analyst last week, following on from last Sunday, we did look at multiple contrarian opportunities, of which there are quite a number. We also looked at why planning for the next bear market is a self-defeating thought process. If you're trying to anticipate what the market is doing and position yourself accordingly, then you're probably going to get off on the wrong foot, because unless you get lucky and your prediction turns out to be true, which would be just pure luck, then you're going to end up positioned completely upside down. So it's not a good thing to do. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.